webinar is about teaching you guys and also being able to educate you in what it takes to get to home ownership all the way from the beginning through the closing table. So we're going to go over all that information here. And I'm going to start with the simple real estate agency. When it comes to real estate, there's different ways that an agent can represent you. And maybe some of you have already worked with an agent and you already know the different types of agency that there are. But if you haven't, there is what's called the buyer's agency, which that is when an agent exclusively represents you in your best interest throughout the whole process. And that is the highest form of representation. And that's the form that personally as a buyer agent, that is what I always, I give my clients exclusive representation, which means that I would never represent both the seller and the buyer in the same transaction. And that is the best way to do it, because you want somebody to represent your best interest, especially when they're negotiating on your behalf. And then you got the seller's agency, which is when the listing agent is representing the best interest of the seller. So that is the listing agent. And then you got what's called dual agency. Dual agency it's when the agent represents both the buyer and seller in the same transaction. So maybe they're the listing agent, there's a buyer that comes to the property and decides to submit an offer without an agent. So that agent agrees to represent that buyer, and then they're representing both interests. And a lot of people don't like that type of representation, because how can you serve two masters at once? Some people think that it's impossible, it's hard to do, it's hard to protect both interests equally. So some agencies, some brokerages don't even do dual agency. There's different types of dual agency. There's designated dual agency, which we practice here at Rex, to where if there is a direct buyer, a buyer that is not working with an agent, then we can represent the buyer via designated dual agency, which means that we have one agent representing the best interest of the seller and another agent representing the best interest of the buyer. So making sure that everybody's interest is protected, and designated dual agency is the best way to form of dual agency if you are having to do that. All right, so let's talk about real estate agent expectations. What are the do's and don'ts that agents, what they can do and what they cannot do. So with do's, make sure that your agent keeps you informed every step of the way. You want to make sure that your interests are being protected. Communication is very key in a transaction. I personally try to communicate to my clients as often as I can, even if I don't have news for them. I still communicate with them to make sure that they know that I'm on top of their either their loan or on top of the whole transaction. Don'ts: do not share whenever you get qualified or pre-approved with a lender. Don't share your maximum price. You can share a range with them, but because if you share your maximum price, they're automatically going to be looking at that max, right? Unless you want to go to that max price that you got pre-approved. Just go over with them your desired price range, and if it happens that you can't find anything within that desired price range, then obviously you got that max in the event that you need it. And do's: your agent should help you identify the properties that meet your criteria within the desired market until you feel comfortable in submitting that offer for the right home for you. So make sure that you're the person that is driving the bus. Although your agent can advise you of what to offer, and you essentially is you who is the client, and you're the ones that is pulling the shots. So make sure that you don't let any agent steer you to a property And just know that a lot of traditional agents, they are 1099 employees, and they know ahead of time what a particular listing is going to charge, what a seller is going to pay on that listing. So make sure that you don't have an agent driving you to or steering you to a particular property just because they're going to get paid more on the deal. Just make sure that you are the one that is driving that transaction. But the agent can definitely, in representing you, they definitely have the ability to go over with you and to just let you know their expertise and what to offer. They can do that, but just make sure that your interests are being protected at all times. Dues, repairs, if they're needed in the transaction, your real estate agents, they need to work with you to determine how you're going to address repairs. There's different ways that you can address repairs. Once you get to that point, your agent will go over with you all those different ways. But really quickly, either the seller pays for the repairs at closing, in a form of a credit, or you can negotiate to where the seller is doing the repairs. Just make sure if the seller is doing the repairs that you're getting a reinspection to make sure that those repairs were done according to code and standard and in a work-like manner. So just want to make sure that you're getting invoices as well, because if there's any warranties, you want to make sure that you are getting those the warranty paperwork as well that comes with that. And then you can also put any repairs into escrow. That's a possibility. And with some loans, you can put repairs into the total loan amount. And then your real estate agent should not influence you to choose any particular vendor or inspectors. In fact, an agent has to give you at least 3 companies. So if they're referring you inspections, they have to give you at least 3. That way you can do your research and see which one it's the one that works better for you. So make sure that somebody is not driving and trying to get you to use a particular person there for inspections. So how are real estate agents compensated? Real estate agents are compensated, so pretty much it's fixed into the list price and market. Here in North Carolina, where I am an agent, the compensation for a buyer agent falls within 2.5% to 3% of the total sales price. And these fees are paid from the seller's proceeds. There's have been big discussions of who's really paying for that commission, because without a buyer's loan, the seller would not be able to pay that commission. So so essentially it comes out of the seller's proceeds, and that's why they say that the seller is paying for that commission. So the 2.5% and the 3% are definitely it's one of those things that when you have a buyer agency agreement, which we're going to talk about a little bit in the next slide, I believe, you want to make sure that you are not paying more than what the seller is willing to pay for the commission. So if the MLS listing, if you're using a traditional agent and you're looking at the MLS listing, if they're charging a 2.5% and the buyer's brokerage is charging you 3%, you don't want to come up with that extra 0.5% at closing, because that's what's going to end up happening. So you want to make sure that you know what that percentage is, and you want to make sure what the percentage is also on the buyer agency agreement, so that you're not having to pay extra at closing. So buyer brokerage contracts, these are put in place because you have to be protected, right? And also the agent wants to be protected. They're going to be driving you. They're going to be showing you homes, and then they want to make sure that you're committed, and also the agent is committed as well. And each party has responsibilities. that are spelled out in that buyer agency agreement. And and you should always have an agreement which best meets your needs as a home buyer. Make sure that you understand every term when signing any buyer agency agreement. Make sure you know your rights. Make sure ask the right questions. In the event that I want to get out of the buyer agency agreement, how does this work? Just make sure that you understand, how you can get out of it if you need to get out of it. There's certain circumstances where you can, when your agent is not doing their job, you can get in touch with their broker in charge and explain the situation. Sometimes they'll ask for you to write a letter and submit it to the broker in charge. And in most cases, they will let you out of that buyer agency agreement if there's a good reason. Make sure you understand that. Make sure that the brokerage contract has a duration, has a set expiration. Make sure that it's not an open-ended that never ends brokerage contract. Make sure that, and typically they're about 6 months, but it's negotiable. So if you only want it for 3 months, you can bring down that as well to 3 months if that's what works best for you. Make sure that you're not paying any retainer fees or deposits to get into a buyer agency agreement. You shouldn't have to pay those fees. And make sure you understand what is the real estate commission that brokerage is charging. Because if the MLS quotes a different, lesser amount than that buyer agency agreement, then at closing, you will have to pay that extra. If that seller did not pay enough for that commission, the buyer agent commission. So how to prepare for the home search. This is a lot of buyers that I come across. Most buyers, they begin that search way before they even contact me. They'll start researching communities on Google. They'll start, or their favorite search engine. There's different websites out there that you can look and start researching different communities. For schools particularly, a lot of my buyers love schooldigger.com because that website pretty much just ranks the schools statewide. So in whatever state you're in, School Digger will give you a lot of information. So if that's important to you and you have kids and you want to make sure they're in a good school system, School Digger is a really good resource for that. Crime reports, we have, you want to make sure you research the crime rates. City-data.com is a really good resource. All you have to do is plug in the zip code where you're going to live in, and City-Data has a lot of data that they pull from public records, from census. It comes from different government agencies, and it's just in one website, and it gives you a lot of information, a lot of stats in a particular city, and for you to make an informed decision. So I'd highly recommend doing that, and I mean it'll go over with you a lot of information, a lot of questions that you have of a particular area. It will cover those questions for you, definitely. The market analysis, make sure that way before you even submit an offer to purchase on a particular property, make sure that your buyer agent is doing a market analysis on that property, because you want to make sure that you are, that they priced it right. You want to make sure that that home is priced right, because if you don't, especially if you're putting a low down payment or if you're getting 100% financing, like USDA loan, you are definitely, that's important to you. You want to make sure that that home is priced right. I know that in some markets, because of the lack of inventory, it's a little tough because you're getting, there's a lot of buyers out there and they're sort of kind of fighting for the same properties. So, in those areas, multiple offer situations are very likely. So you want to make sure, but still, even in markets that are where multiple offers is very likely, you want to make sure that the value is there for the property, right? You don't want to end up overpaying for a property. And then, another good source of information when looking to and learn about the neighborhood, you can talk to neighbors. Don't be afraid to knock on the door next door of the property that you're interested in and just ask neighbors. Neighbors will tell you a lot of information that your realtor or your agent will not know. Neighbors live right there. They see everything that's going on in the neighborhood. I recently I talked with one of the neighbors on one of my clients' properties, and the neighbor, said that 2 weeks ago they had, there was a group of kids that went in the neighborhood and started stealing personables from the cars. So it's very important for you to do that, and because you can learn a lot of insights just by talking to the neighbors in the neighborhood. Area values, in addition to the input of your agent, you can access, Zillow. As you know, Zillow has captured about 90% of the market share, and a lot of buyers and a lot of properties are on Zillow. Most of the properties are on Zillow. If they're for sale by owner, if they're on the MLS, or or if it's a Rex property, it'll be on Zillow. Zillow pretty much just, everything pretty much feeds into Zillow. So any property you'll have there. Also, you have a great section there on Zillow, which is going to be the recently sold properties, which kind of can give you an idea what those properties are selling. And then there's many other online services, that you can go and look at property values and look at what, different zip code or a different area, what those values are doing. Property taxes and utilities. This is one thing that, a lot of buyers overlook, especially the utilities. You want to find out, what utilities cost. You can ask the seller. You can have your agent ask the seller what they pay in utilities, their average, utility bills, and most of them will tell you what their averages are. And you can even contact the electric company. You can contact the water company or the utilities company in your area. And in most cases, they will tell you what the average is by giving them just the address. They will tell you, what those averages are as well. Property taxes, you can find property tax information fairly easily. You can Google the data, but a search, in most cases, that will pop up the website for the county where that property is located. And those real estate taxes are public knowledge. So you'll be able to see it there. And in most cases, also your agent can share those property taxes with you as well when they're going through with you on the listing. The purchase and sales contract, make sure before you even sign anything, once you have identified a property, you want to make sure you thoroughly go through the purchase and sales contract. And in fact, I personally give a blank purchase and sales contract here in my area to every buyer that I come across, because I want to make sure that they can start reviewing it prior to them finding a property, so that they can become familiar with the terms of the offer to purchase and contract. So, you can do the same thing, and that way you can get familiar with those terms. Communication is very key. I mean, it's like the number one thing. You want to make sure you have an agent that's a regular communicator, somebody that is going to be with you every step of the way, and as well, a mortgage consultant or loan officer that's going to be with you every step of the way. Any questions that you may have, you want somebody that's going to answer you probably within a 24-hour period. As some agents and some mortgage consultants are very busy. So some of them, as long as they get back to you within that 24-hour period, if it's not something that is and that is a crisis or something that is needed right away, 24 hours is okay. But of course, somebody that's communicating with you as soon as possible. Make sure that you keep your documents up to date. Once you get pre-approved, make sure that you have your pay stubs, because your loan officer is going to ask for those things again. Because sometimes it could be months, or sometimes it can be a little bit longer. When you get on the contract, as soon as you give a contract to a mortgage consultant, they're going to ask you for you to give the pay stubs, tax returns. So, especially if it's a new year and it's March, April, when it's deadline for taxes, they're definitely going to ask for those tax returns and new tax returns. So make sure you keep up to date and organized, and so that when your mortgage consultant or your loan officer asks you for updated documents, you already have it there. And as you know, once you're on the contract, time is of the essence. You want to make sure that you're prepared and that you're sending these documents to your loan officer as soon as possible, so that you can get that final clear to close as soon as possible. For those buyers that don't have much money for down payment, there's programs out there, and they're all over the place. I mean, you can go to the HUD website and look in your particular county or in your particular state. There's always grants that are out there that buyers can utilize. Of course, there's requirements that they have to meet. Sometimes they have income requirements, and then you can go to the HUD website and research that information. So if this is something that you need, down payment assistance definitely is the way to go if you really need it. Now, just know that if you're using down payment assistance, just typically, rates are higher with that. So make sure that you talk to your loan officer, somebody that is a licensed loan officer, to explain to you the differences between down payment assistance program loans or if you were to just go, FHA with a 3.5% interest rate, just make sure that you that they explain to you what, how much more you're paying for down payment assistance. Of course, government will have to make up for that assistance that they're giving you, so they're going to increase the rates if you opt to go that route. So in order for you to get approved for down payment assistance, if this is something that you want to do, you will have to complete a home buyer educational course. And you can go to the HUD website, you can put your zip code there, and it will tell you all the counseling agencies that offer these HUD certified home buyer education. In some cases, you can even do it online. I think now after COVID, they're doing them online. So you can go and read the material, and then after that, you have to take a test. And then once you pass that test, I believe you have to pass with like 78%. And then they'll give you what's called a home buyer certificate. And that certificate, you will have to give it to your loan officer, and your loan officer would then pretty much just put it in your file, and because that's one of the things that the underwriter is gonna require for that down payment assistance. Make sure that, with providers, they often, the way that it works is that they often will have put one of the documents that you'll sign at closing would be that you will have to pay this down payment assistance if you do not stay in your property for 5, some 10 years. It depends on the grant. They're all different, and just make sure that you understand if you're going with down payment assistance, you understand some of them are forgiven after 5 years. So after 5 years, you would not have to pay it back. If you sell your house before that 5 year, you might have to pay prorated depending on how many years you lived. So just know that, it's definitely something that you need to look into and make sure that it fits your needs. And if it does, then it's a great resource for those people that don't have that down payment that is normally required to be able to purchase and get approved for a loan. Okay, and just know that there will be a lien placed on the house in second position after the lender if you are opting to go this route with down payment assistance. So let's talk about mortgage options. There is many options available to buyers. Conventional loans are loans that fall within the Freddie Mac's guidelines. So pretty much, most lenders, they sell their loans to the secondary mortgage market. So they want to make sure that it meets those guidelines because they want to be able to sell them so that they can get more money to lend other buyers. With conventional loans, typically they have a 3% to 5% down payment required. You have to. I know some lenders can go as low as 3% for conventional loans, and some lenders go at least 5%. So just talk to your loan officer and try to see which is the loan that best fits your needs. And then you got your non-conventional loans, which are going to be your jumbo loans. Jumbo loans are loans that are loans that are over the conforming limits. I believe the conforming limits in most areas are 510,400. That's the exact number that I saw on the Federal Housing Finance website. On there, you can look at the limits that are within your area. So if you're looking to get a jumbo loan, this is a huge loan, which is going to be more than 510,000. After COVID, a lot of lenders have pretty much just become stricter in their lending, and some of those jumbo loans have pretty much just they're getting a lot more stricter. Some lenders did away with jumbo loans for now because they're trying to take less risk, because just eventually there's going to be this a lot of people that are going to be foreclosed on because there's a lot of people that lost their jobs, and they're trying to mitigate that risk from the beginning now. So they're starting not to do those jumbo loans. So if this is something that you're looking to do, just talk to your lender and talk to several lenders to see who can give you the best rate. And then FHA, it's the Federal Housing Administration. The minimum down payment for FHA is 3.5%. And then this, you need that at 3.5%. That is a requirement with FHA. Just know that typically the FHA has what's called a mortgage insurance premium, which is, it costs more to get an FHA loan. But if you don't have the down payment or the credit requirement, the credit score requirement to go conventional, with an FHA loan, you can go, with a 620 credit score, you can go FHA. Some lenders will go even lower than that. I know that after COVID, a lot of lenders, like I said, they started to be safer on their lending. And it used to be that somebody with a 580 credit score could qualify for FHA, although a lot of lenders have overlays, which means that they have stricter guidelines with credit score. But actually, the Federal Housing Administration, they can do loans at 580 if the lender is willing to do it. But after COVID, it's going to be tough to get qualified for an FHA loan at 580. I think now they want to see at least a 620 credit score. And when they're looking at the credit scores, they're looking at the middle of the 3 credit scores. They're not looking at your lowest credit score, and they're not looking at your highest. They're looking at the middle. So it's very important for you to also research and find out, what your scores are prior to you go to your mortgage consultant as well. So you know where you're going to fall in terms of whether you can go conventional or FHA. And then VA, the Veteran Administration, that is the best loan that you can get by far. VA has really good rates, 100% financing. They can include repairs into the loan. So, you know, if you have a family that is a veteran, or if you're a veteran, VA is the way to go, you know, all the time. And then USDA government loans, these are for loans that are in rural areas. So if you're looking to be in a rural, you don't want to be in the city, you want to be outside of the city, you know, you can go to the USDA website and pretty much just plug in any address, and it will tell you if that address is USDA eligible. So in order for you to get 100% financing, you have to purchase in a rural or semi-rural area, and then they will be able to do the loan, but they will not be able to do a USDA loan on a city. So just know and understand before you apply for USDA loan that you're getting into a property that is USDA eligible. Now with USDA, there's some cost involved with it. So make sure that you understand what those costs are. They have an upfront funding fee, and I think that funding fee is 1%, and that's being added either to that total loan amount. And so, you know, if you can go conventional, you know, it's the best way to do it, because then you wouldn't have to pay those funding fees or that FHA mortgage insurance premium that can be either paid up front or it can be added to the monthly payment. So, you know, conventional is, if you have the credit requirement and if you have the down payment requirement, then that is definitely the cheaper way to go, especially with rates being so low right now. Mortgage payment, what does it consist of? So mortgage payment consists of, you know, it's commonly known as PITI. It's going to be your principal, your interest, your taxes, your insurance. Even though your HOA is not included in the mortgage payment because it's a separate payment you do to that HOA, the lender is gonna make sure that you qualify for that HOA, because sometimes those HOAs can be very hefty. I've seen HOAs that are $350 a month. I mean, yeah, they do everything and they take care of the exterior maintenance. They mow your lawn. They do it all. They even give you the insurance, master insurance for the outside. But you know, want to make sure that when you get qualified, that your principal, interest, taxes, and insurance and the HOA fits within what your loan officer qualified you for. Mortgage payment limiting factors. When a loan officer is going over your situation and assessing what is the highest that they can qualify you for or pre-approve you for, they're looking at what's called, one, the housing ratio. They want to make sure that and just know that every product is different. This is just sort of kind of a, you know, just for you to understand how they come across that, but those ratios can actually be higher depending on the product that you're qualifying for, and your loan officer can go over with you those ratios with you depending on that product. But typically, a loan officer, you know, doesn't want when they're looking at your gross income, you know, they want that housing ratio to be about 28% to 31% of your gross income. And then the debt to income ratio, when they are looking at your monthly liabilities on anything that is reporting on your credit, like, you know, if you have a car loan or if you have a student loan, credit card, you know, they're looking at the monthly payments that you are currently making on those liabilities. So they don't want that to exceed over 40% or 43% of your gross income. So, these are limiting factors that can limit how you get pre-approved for. And so obviously the higher your income, the lower your monthly liabilities are, the more you're going to be able to qualify for. So how do lenders assess credit worthiness? They're looking at character. They're looking at your credit history. They want to make sure that you've paid your bills on time, especially those reporting on your credit report. They want to see at least 3 trade lines of credit with good sufficient history that you've made those payments on time. And then they're looking at capacity. They're measuring, what is your ability to pay, how well you've performed in paying your previous liabilities. And they're looking also at capital, what you have in savings, the amount of money that you are going to use towards the purchase of your home for a down payment. They're assessing all of that. And collateral, an asset that can act as a security for a loan. And then you have conditions, which is, the reason for the loan, why are you acquiring that loan, the amount that you're asking to borrow, and at the current rates. These are examples of closing costs. This varies per market. So just disclaimer here, it could be different in your market. So these are just averages, typically, of what it would cost for the mortgage closing costs. So aside from your down payment, you have what's called your mortgage closing costs. And your closing costs consists of appraisal fee that can range between $300 to $500. The home inspection will be, and typically this is paid outside of closing, it's between $300 to $500 depending on the square footage of the home. You have the application fee, which varies per lender. Every lender charges, different origination fees. Like if you're going with a mortgage broker, they might charge a percentage of the loan to originate the loan. Or if you're going with a lender, most of them have just a fee, just a flat fee that they charge to originate the loan. You have your attorney fees to draft the documents, the closing documents for you, to do the title search. So typically they charge anywhere between $500 to $1,500, depending on the market. Every attorney charges different, and so sometimes it's good to figure out, different attorneys and to see what they charge, because it can be a big difference from one attorney to another. The prepaid interest, it's, from the day of closing. Once you close, you're going to pay prepaid interest from the day of closing all the way through the end of that month. So that is your prepaid interests. Since you're not paying a mortgage payment at the closing table, you're simply going to pay the interest from the day that you close all the way through that end of that month. And then you skip a month and then you pay your first mortgage payment. Origination fee, if the lender charges an origination fee, it can be anywhere between 0.5% to 1% of the loan amount. And when you're looking at the good faith estimate, make sure, and that's why I always encourage my clients to shop around for mortgage, because just to give you a little idea of what just a 0.25% difference between one lender from another, it can save you, it can mean saving you $40 a month. Over the 30 years, that is over $14,000 of savings, just because if you decided to go with a lender that is 0.25% cheaper. So it makes a huge difference. So I always encourage buyers to look for different lenders, at least 3 lenders, to see who gives you the best rates and the best terms. Property taxes, typically, these are going to be, you're going to pay about 2 to 3 months, sometimes more, depending on when you're closing. But typically is somewhere between 2 to 3 months. And these are going to be held in reserve. So these are called reserves. And pretty much is going to be put into an escrow account. And every time you make your mortgage payment, you know, they're going to take what's the property taxes, and they're going to take, you know, the mortgage insurance, if there's a mortgage insurance, and they're going to put it into that escrow account. And then if there's any HOA fees, these are going to be prorated at closing. So you know, you might have to pay closing fees, you know, to the to that quarter or that year, depending on what the HOA, you know, different HOAs charge differently. Some are monthly, some are bi-yearly, some are quarterly. And then you have your mortgage insurance. You know, this is something that, you know, it's going to depend on the home value and the location of the property. You know, that you're going to pay 1 year of home mortgage, you know, homeowners insurance at closing. And that's part of your closing costs. Title search fee, and that can be, you know, it's about $200, but it can be more in other markets. And then if you're doing a lender's title insurance, so every lender is going to require a lender's title insurance if you're getting a loan. The owner's title insurance is optional. I always recommend doing an owner's title policy because you want to make sure you protect yourself. The lender's title insurance is only protecting the lender. So if you have an owner's policy, it's going to be protecting you. So make sure that you are getting owner's title insurance to protect you. And this protects you in the event that somebody comes and says, hey, I'm the owner of this house. I have deeds from like a long time ago that prove that, you know, that person, essentially, if there was a cloud in the title, they have rights to that property, and this owner's title insurance will protect you in that they will pay what you owe on that loan. So it's, you know, it rarely happens, but it could happen. So that's why it's always important to protect yourself having an owner's title policy. So typically an average closing cost for the buyer runs about 2 to 5% of the loan amount, depending on the market. In different markets, there's different closing costs as well. The mortgage credit certificate. A lot of buyers have not heard of the mortgage credit certificate. Mortgage credit certificate is a great way of you being able to utilize a tax credit that the IRS gives low to moderate income individuals. And you can get up to a $2,000 a year credit. And what this means is that you can use it as income. So if you qualify for it, and your loan officer will be able to give you the details on it. Depending, every state is different. There might be different income requirements for every state. So make sure that in the state that you're in, when you're talking to your loan officer, if you're interested in doing the mortgage credit certificate, just make sure that you're understanding, you know, sometimes it doesn't make sense to do, sometimes it does make sense to do because you're adding an additional $2,000 of income, which can help you qualify for a little bit more of a home if you're needing it. And then also it allows you to, you know, this credit promotes affordable housing. It can help you increase your monthly gross income, and it improves the odds of qualifying because your income is a bit higher. And then also the buyer may continue to receive the credit as long as you live in the property. So if you sell the property, you can no longer claim this credit. You know, you can only claim it on that particular property while you live at that property. And another cool feature about the mortgage credit certificate is you can actually reduce your tax liability by $2,000 a year. You know, you can talk to your CPA on how to do that. You just have to fill out the W-9 form that your employer gives you, and you can claim this liability. That way you can take a little bit more home. Your net is going to be a little bit higher. So this is a great way for somebody that really needs, to bump up their income a little bit to qualify for more, and to utilize and use that tax credit. So ways to improve your credit. So if you're a person that needs to improve your credit, the first thing that you have to do is pull your credit from all 3 credit bureaus. There's a source, a website, annualcreditreport.com. You can do that free to identify any discrepancies that you can dispute. It is said that it could be, there's a big probability that somebody might have some discrepancies in their credit reports that might be affecting your scores. Sometimes you might be, your name is similar to somebody else's name, and an account, might be put into your credit report in error. So you want to make sure you're looking at the reports at least every 6 months to make sure that nothing is going into your report that is affecting your credit scores. So if there are things on there that are not yours, and you know for sure they're not yours, you can dispute it with all the 3 credit bureaus, and if you can prove that that's not your debt or your collection or whatever it is, they have to take it out of your report. And then that essentially will increase your credit score. Make sure that you maintain a revolving debt balances on your credit cards. Make sure that you are keeping it under 30% of the available credit. Because as soon as you go over that 30%, it's going to start affecting your score. If you're needing to increase your score a little bit quicker, if you have a parent or if you have somebody that can put you as an authorized user on one of their personal accounts, if you're doing that, just make sure that that person really is on point with their payments, and they have a high, they don't have high credit utilization. Make sure, because then obviously it's going to affect you even more if you become an authorized user on somebody that's not making their payments on time. You can also try requesting a credit limit increase on your credit cards, which will improve your credit utilization, and that can also improve your scores. Do not apply for any credit, especially when you're when you're on the contract and you are trying to close. Make sure that you're not applying for credit, especially when you go to a department store and they're asking you, do you want to save that 15%? Make sure that you're not having them pull your credit, because every time they pull your credit, it's going to affect your score negatively. And do not close any unused credit cards. As soon as you close a credit card, your scores are automatically going to go down. It's going to negatively impact your scores. So make sure that you're not closing any credit cards, and then clear any outstanding collection accounts. If you have any collection accounts, just try to settle with them. Try to settle as payment in full, and them taken out of your credit reports. I've had clients that have been able to successfully do that. If there's any collections in your accounts, you can negotiate with that debt collector or that creditor for them to where you could pay, essentially, especially if you pay it in full, you have a higher probability of them taking that off your credit report. Different types of properties. So you have single family home. These are going to be your detached. That is probably going to be on a planned unit development if it's in a neighborhood. You can also be in a detached on not in a neighborhood. It can be an older neighborhood that doesn't have an HOA. Then you have your row houses, which are going to be like your typical neighborhoods and typically they do have HOAs, homeowners associations. HOAs are good and bad. There's its pros and its cons. it protects you in the sense that nobody's going to build anything crazy that's going to affect the values of your property. And then you have also to where, you know, they're going to have strict rules, and you know, they're going to tell you what you can't do with the property. So that, I know that there's a lot of buyers that they like it. Some buyers don't like the HOA, but you know, just make sure that you understand what you can and what you can't do to the property if you're getting into a neighborhood that has an HOA. With mobile homes, manufactured homes, these are homes that are built in a plant somewhere. They're not built on site like your stick-built homes that are detached. With mobile homes, there's a little bit of pitfalls with mobile homes if that's something that you're looking to do. So you just want to make sure that your agent is informing you of the extra inspections that they're going to be with mobile homes. You know, the lender is going to require at least, they're going to have you're going to have to do what's called a structure engineer's letter. And that's going to be part of the lender condition. So if you're doing a mobile home or manufactured home, they want to make sure that the lender's going to make sure that it's on a fixed foundation. So, you know, in that letter, it can cost anywhere between, I've seen it, $250 to $350 just for that letter. And then on top of that, you have your inspections to do. So it's going to be a little bit more money that you're going to have to pay upfront for inspections on manufactured homes. Then you got your townhomes. You know, these are going to be your, you know, with townhomes, you pretty much you're responsible from the studs inside of the house. In most townhomes, when you're taking out your homeowner's insurance policy, you're only covering the dwelling, because in most communities, HOAs, they have a master policy that covers the exterior of the property. So you know, it's with townhomes is great if you don't want maintenance. You know, you're not going to have a big backyard. You're not going to have as much maintenance as with a detached home. You have your also the purchase rehab. So you're looking for a fixer upper and that you want to fix. You know, there's also some loans that you can do rehab, and you can include a certain percentage of the repairs into the total loan amount. Again, if that's something you want to do, just talk to your lender. They'll be able to point you in the right direction if that's something that you're wanting to do. Just make sure you mention that at the beginning so that they can, you know, because sometimes it's a different loan officer that is doing that, because it's somebody that really has to understand what the rehab and the draws and all of that process. So not every loan officer can do a rehab loan. With condos, co-ops, you have to be at least, most lenders will require at least 50% owner occupancy. And when comparing to renters, you know, they want it to be at least 50% owner occupied in order for them to lend on that. So make sure you understand that. They're also going to require, you know, the HOA to be financially fit. The lender is going to send what's called a condo questionnaire. With the condo questionnaire, there's going to be a lot of questions that they're going to ask. And in most cases, they're going to charge you to do this HOA questionnaire for a condominium. So make sure that you are prepared to pay whatever that HOA charges. Sometimes I've seen them up to like $300 just to fill out a piece of paper. Co-op, it's limited in certain areas. You know, it's more up north where co-ops are limited, and you know, it's not very popular here in the South. At least where I'm from in North Carolina, we don't have any co-ops that I know of. Multifamily, lenders can lend up to 4 units. After 4 units, it's commercial loan. So you have 2 to 3, 4 units. You have to live in one of the units for multifamily. So it requires a landlord training. So if that's something you want to do, multifamily, make sure that you're taking that landlord training class online. Your loan officer can direct you as to the website where you can get this done. And also it requires more reserves, more savings for you to be able to purchase a multifamily. And the logic is that if you buy a multifamily, you're going to be a landlord, and if something breaks down, you have to have the money to be able to fix those items. And you have a higher down payment requirement as well with multifamily. All right, so we're going to, I'm going to walk you through a, from purchase contracts, or you identified a property, all the way through close timeline. And just disclosure here, disclaimer, timelines vary from market to market. This is just a best case scenario timeline. There's so many moving parts in real estate, especially with seller and buyer. There's many different timelines with them, and it's just sometimes things can get delayed. But this is just so you can get an idea, for informational purposes, so you get an idea on what transpires from you getting on the contract all the way to the closing table. So let's say on day one, you submit an offer, is accepted, it becomes an executed contract signed by all parties. At that point, the lender receives the contract, the addendum. Whenever your agent sends the contract to your loan officer, make sure that he's sending everything with all the addendums included. They can be pretty much, you can submit it directly to your, you can email it to your loan officer, or you can sometimes have a portal where you can put it in there. Make sure you're sending a copy of the earnest money deposit or the deposit. In some cases, it's called, there's also an option fee or a due diligence fee. Make sure that for any deposit that you're doing on a particular transaction, you're sending your loan officer a copy of that, of those deposits. And sending them a copy of the listing MLS sheet, listing agreement, because this will have a lot of information on the property, like the HOA dues, the taxes, information that the loan officer will need to be able to put in the system to make sure that the ratios will work. And then you contact your mortgage consultant, set an appointment with them. If you need to update your file for underwriting submission, either you go to his office or send everything via email. I know that a lot of people like to do things face to face. Some like to do things online, but just make sure that you're sending everything to your loan officer as soon as possible. And then, with day two, just collect all the documents, submit to mortgage consultant, make sure that you're getting everything squared away with what they're requesting. They're going to send you what's called a loan estimate. Just complete that intent to proceed. They're going to send it to you via email in most cases. Make sure that you click on that email, that you confirm it, and then just make your agent uploads the email, pest inspection report, wood destroying insect report, and just make sure that your agent is helping you, schedule these inspections, and make sure that you're getting people that are licensed to do these inspections. By day 5, you want to have that homeowner's insurance policy. Make sure you contact your agent, your insurance agent. Make sure that the homeowner's insurance policy is 100% replacement, which means that if the house were to, for some reason, burn down, that you will get 100%. They're gonna replace it by 100%, and most lenders require that. So day 6, if they require more additional information to send to underwriting because they came back, just make sure you complete that as soon as possible. Day 7, keep communicating with your mortgage consultant, your agent to review any repairs. By then, you should have already your inspection report. Go over it with your agent. Make sure you discuss the repairs and how to negotiate with the seller. Just provide evidence of insurance to the lender, by day 7, typically no later than day 13, because definitely that can, if you don't give it to them on time, you can miss your closing date if you don't give them what they're asking for. By day 8, make sure if there's any contractors that you're trying to vet, make sure that you get that schedule so that they can give you the estimates for the repairs. And then that way you can better negotiate with the seller. By day 9, you want to make sure that, repairs, negotiations, sales are determined, make sure that you are completing it. You know exactly where you're going to negotiate in terms of repairs. So this is just a timeline. I'm not going to go over it all. You're going to have a copy of this. Day 14, 15, just make sure that you understand that if it's in a flood plain, you need flood insurance. You need, you want to make sure that you get that secured if there is. So, it's just for you to get an idea of what transpires day to day and what you should be doing on a day-to-day. And by day 28, essentially on a perfect case scenario, loan closes, you close, and then once you close, you get the keys to your home. You'll be a new homeowner. So definitely it's a lot, and I hope the information here was valuable to you. And then just want to go over quickly about Rex and what we do here. We're a full service brokerage, like I said. We take care of our clients every step of the way. We are not commission driven here at Rex. Every one of us is salaried employees. We're going to look after your best interest every time. Since we don't have that, that 1099 mentality like the agents, where, sometimes they're doing things that it's outside or not in their client's best interest. Here at Rex, we're going to do everything that we can. So we have Rex Home Loans. If you need to get pre-approved, if you haven't gotten pre-approved, we have great loan officers on our team. They're very experienced, and they are very communicative. They'll be holding your hand every step of the way. We have great rates here. Here at Rex, wholesale rates, we've been able to beat a lot of your big time lenders' rates. So, shopping rates is not a bad thing. If you know that if you're shopping a rate, when somebody pulls your credit, you have 14 days before it starts affecting your credit again. So you want to make sure that you are shopping your rate, because like I said, a %.25 difference can mean $40 a month, which doesn't seem that much, but once you calculate it into 360 months, 30 years, it's over $14,000. So you can save a lot. We have Rex insurance as well. If you need auto, if you need home insurance, if you need pet insurance, we got many products available there, and we have great rates there with Rex Home Insurance. So if you need insurance, we provide that also, a service to our clients. We have our title and escrow services. Pretty much we keep, the title insurance. If you need home warranty, we have that all for our clients, and we save you money by bundling. If you're bundling some of these services, you save even more money. As a first-time home buyer, we're giving a credit of $1,000. We give it to you at closing. You have to close with Rex, and you'll get that $1,000. And home services. You know, if you're needing vendors, if you're needing help with you know, inspectors, and we pretty much just streamline the process by having all these partners that we have, and to make your transaction just seamless and more efficient. And then if you use Rex as the buyer agent, we will give you 50% of our commission at closing. So, which is phenomenal. I mean, I don't know of any agent giving 50% of their commission away to their client. We want to make sure that we are putting more money in your hands, and you have the opportunity to get up to $7,500 on average towards your closing costs back in your pocket. It's all done through escrow, you know, so you can definitely put those invoices, like if you need like flooring or if you need home improvements, you can put that into escrow, and put it into the invoices, give it to the attorney, and you can use that credit that Rex gives you back, and essentially, you know, you can reduce the amount that you can bring to the closing table as well, because you can cover a lot of your closing costs, or all of your closing costs in some cases, with that 50%. So that 50% could be a huge help for a lot of buyers. And you can go to our website, you can do the scan here with the QRC code as well, if you're needing more information on the rebate program. So it's, you know, the way that it works is it's very easy. You know, we have buyer agents on the team that would look after your best interest, have local knowledge, you know, and we do our thorough due diligence for our clients. We help you negotiate and offer the terms. We're fully licensed agents, you know, and oversee the contracts for you and explain to you everything, and pretty much just do everything, and fully escrow support as well. Yeah, so just benefits of working with us is just you know, we're honest, and we always do what's best for the client, and you know, with mortgage consultants, the same thing. You get flexibility on pricing, you get honesty, you get knowledge. I mean, they have many years of experience. We have agents here with a lot of years of experience, and they know how to best negotiate for their clients. You get the personalized attention, hand-holding throughout the whole process, and pretty much just offer different options to you, and what best fits your needs. And integrity it's the number one thing that we run by here at Rax. We have post-purchase concierge services that include, if you need to sell your house, you know, we can help you sell your house for only 2%. Insurance needs. If you need to refinance, we can help you with that. If you need home automation or security, we can help you with that. Pest control, moving services, landscaping, flooring, painters, remodeling, pretty much you name it, we can help you. We can help you secure those services. And we, aside from, you know, us being a brokerage, we have a great social mission, which is, you know, for every 50 home to the poor, and we're partnered with World Housing, so you would be part of that if you decide to work with Rex. You can follow us on social media: Facebook, Instagram, LinkedIn, Twitter. These are all our social media avenues there. And, you know, thank you so much for just listening and going over. I know it was a lot of material that we covered.